All right, let's get right into it. Today, we're doing the market's daily checkup for August 26, 2025. Think of it like we're taking the vitals of the U.S. economy to see how it's really feeling. And first off, the year-to-date bill of health, it looks fantastic. Our patient, the economy, is looking strong, with the S&P 500 up a whopping 35% so far this year.
But, when you peel back that one big, strong number, the picture gets a little more complicated. Today on the New York Stock Exchange, you had 76 different companies hitting brand new 52-week highs. At the exact same time, you had 7 companies hitting new lows. So what does that tell you? It tells you that investors are being pretty selective. There's confidence out there, for sure, but there's also a whole lot of caution.
To really understand this mood, our first diagnostic test is going to be reading the raw materials. Let's see what these hard assets can tell us about the economy's underlying condition. First up, let's look at gold. It's hovering right around $33.76 an ounce. Now, gold is that traditional safe place to park your money, so even a slight tick up like this can signal some investor uncertainty. Maybe they're not so sure about when the Fed is actually going to cut interest rates. On the flip side, you've got crude oil, which is down to $64 a barrel. A dip like this can point to worries about global demand. It raises questions like, are factories slowing down? Are people traveling less? But then, check this out. Copper, which people sometimes call Dr. Copper because it's so good at diagnosing the economy's health, is actually edging up. A rising copper price usually points to a positive outlook for industry and manufacturing. So you see this mix of signals, right? A little caution from oil, but a little bit of optimism from copper. Okay, for our next diagnostic, let's take the economy's pulse. And for that, we look at the bond market. You can think of it as the circulatory system. It's an absolutely crucial health indicator. Now, before we look at the numbers, just a real quick primer here. The yield curve. It's just a graph. It shows you the interest rates you'd get on bonds that all have the same credit quality, but just have different end dates. The shape of that graph is a really powerful signal about what the market thinks is coming next for the economy. And here's the data from today. You can see the yields for all these different timeframes, from just 1 month all the way out to 30 years. Notice that upward slope, how the rates generally go up as the time frame gets longer? That's what we consider a normal, healthy sign. But the one relationship on this entire chart that everyone, and I mean everyone, watches is the difference between the 10-year yield and the 2-year yield. Right now, that spread is a positive 0.57%. So why does that one little number matter so much? Well, a positive spread like this is a very big deal. It typically signals that investors are actually expecting the economy to grow stronger and for inflation to maybe pick up in the future. It's basically the bond market giving a thumbs up for the economy's long-term health. Okay, so the bond market's pulse is steady. Let's move on to the third part of our checkup, a closer look inside the stock market itself to see where it's showing some strength and maybe some weakness today. This slide really tells you a lot about the market's mood right now. Consumer discretionary, we're talking about things we want to buy but don't necessarily need to buy. That sector is up over 3% today. Communication services is up too. This points to some real optimism about consumer spending. But here's that tension again. There's a catch. The market's overall upside is kind of being held back a bit by these renewed fears over tariffs. And that's putting a lot of pressure on companies that rely heavily on international trade, which helps explain some of that weakness and those 52-week lows we saw earlier. So this gets to the really crucial point. Why the cautious mood, especially with such a strong year and some positive signs? Well, it's because the market is basically in the waiting room right now. Everyone is just holding their breath for a flood of new information. The big test results are due. I mean, just look at this schedule. It is a non-stop flow of critical government data all day. It starts at 8:30 in the morning with durable goods orders. Then we get home prices at 9, and the big one, consumer confidence, at 10. Each one of these reports is going to give us a much, much clearer picture of manufacturing, housing, and just how the average person is feeling about their finances. And it's not just government data. We're also getting a whole other set of test results from some major companies. Before the market even opened, we heard from big banks like Bank of Montreal. And then after the closing bell, we're going to get reports from key tech players like MongoDB and Okta. Their results are going to tell us a ton about business and consumer spending. So, let's write out the doctor's note for today, shall we? The economy's checkup shows a really solid bill of health for the year overall. The patient is definitely strong. But There's a very cautious, watchful mood hanging over everything today, as everyone just waits for these critical test results to come in. And that leaves us with the big question that really sums up the entire day. This checkup, it clearly shows a healthy past. But with all these critical test results just about to drop, what is its future health going to look like? That's what the market is desperately waiting to find out.